flag that we could see in your office or something, but if not, why don't we still do our traditional pledge?
I have a
Okay.
flag.
Oh, that's right.
I'll give you a flag.
You gave us the flag last time, Arnett. I didn't know you were on. Hello, Arnett.
All right, we're ready.
We're ready for our flag.
I'm at,
That's all right. It's all good. There we go. Okay, we ready, everyone?
Yes.
I pledge allegiance
To the flag.
to the flag of the United States of America, to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Beautiful.
Thank you, Arnett.
Okay, and I just saw Paul's face show up, so I think Paul is there somewhere.
Yes.
Yeah,
Paul.
I decided to turn my video on.
All right. It's good to see with a face like that. We want to make sure you're with us. Okay.
Oh, yeah, right.
Yes. All right. So why don't we just, I know I ran down all you guys, but why don't we just say who's on so we can have it officially? I'm Mike Evans, the chairman of the retirement board.
Dennis Flag.
Paul Shea,
Jim Jascott, Finance Director.
Dawn Guy, recording secretary.
Hello, Dawn.
Hello.
Kevin Costa, police rep.
Hello, Kevin.
Steve Jester, Police Department.
Hi, Steve.
David Borrowy, Town Council member.
Hey, David. Okay, and we're good. Okay, so has anyone had a chance? We'll do this as two separate. As you remember, we had our regular scheduled meeting back in February, and then we had our special meeting where we discuss IVA, and Ross will give us the IVA update, the tragedy with IVA in a second. And so why don't we separately, has anyone had a chance to review the minutes of the February 3rd meeting? And if there's any updates we need to make of those. Of the outstanding presentation of both Dawn and Jim. So, is there any updates?
They look good.
They look good. So I'll make a motion to approve the minutes for the February 3rd meeting as presented.
Second.
Second. All in favor?
All right.
Aye. That's simple. Okay, and then we will have a separate one. Has everyone had a chance to review the shorter meeting we did on March 29th to discuss IVA closing out their fund? So any questions, any updates to those?
No.
No? Okay, so I'll make a motion to accept the minutes of the March 29th, 2021 meeting via Zoom. Have a second?
Second.
All in favor?
All right.
Aye, so that's easy. Okay. Old business. We'll do this at the end because it's my favorite thing in the world to talk about investment policy statements. So we're gonna get, oh, and then we have election of officers. So Jim, can you lay that out for us? Is this where they get to throw me out for once and for all?
Yeah, I think we do this once a year, so. Okay. You know what? I don't have the list of current officers. I apologize. Mike, obviously you're the chair, and
I think Dennis, are you the co-chair, vice chair, whatever we could, chair of vice?
Vice chair.
Okay.
I nominate Michael to be chair again this year.
And
I'll
accept
second that.
Okay. All in favor?
Aye.
Aye.
Okay, so I guess you're stuck with me for one more year. I make a motion to have Dennis Flack continue as our vice chair of the retirement board. Have a second?
I'll second it.
All in favor?
Aye.
Okay, that's easy. Congratulations, Dennis. And I
was there
think
also a secretary?
Is Kevin the secretary? Do you
Oh,
remember Kevin?
Marcus.
Oh, Marcus. So that's perfect. So we'll get to vote for him without him here. So I'll make a motion to reappoint Mark Izzo as our secretary of the retirement board.
Second.
All in favor?
Aye.
Aye.
See how simple we make this, Jim? And I think that's it, right? 3 officers?
I'm liking it.
Perfect. We try to streamline the whole world if we can, right?
So we're gonna stay with the current board or the current officers.
Current officers. Okay, perfect. Thank you all. So Ross, without further ado, and we'll, with your permission, although Ross, I know you have the gentleman, I think we have, is it Tweety Brown coming on at 6:30? Is that still happening tonight?
Yes.
Okay, so is it okay if we then just get to investment policy after that presentation? Is that okay? So we can get Ross started right now and then turn, okay, so Ross, why don't you get started? And just before you do that, tell us what's coming up, what's our coming event at 6:30 tonight?
We have a recommendation, and I'll put it on the screen, I guess, in a moment. We had mentioned a little while back that the fellow that manages the Neuberger Berman International Fund has decided that he's going to retire from investment management and go, I think, teach high school math.
That's right.
And well, good for him.
God bless.
He's going to try and undo all the harm he did working on Wall Street by going to educate today's youth. But that causes us to make a decision, and he was integral to that portfolio. So really, whenever you're hiring investment managers, you're hiring people, and so with that, and we try, and there's some other objectives that we try and accomplish, I think, in doing that from a portfolio perspective. There's an investment manager, we'll have them come on, Tweety Brown, and I don't want to steal too much from that conversation. It's not often, or probably ever, that you speak to an investment manager that has 100-year history. So we won't be hearing from the original portfolio managers. They've had some turnover, but I think their people have worked, I think in one case has been there for 47 years, but a very interesting manager, and I think one that, as I'll show, fits well within the portfolio and some of the tweaks that we like to make. So Michael, I mean, it's up, I can, if you like, I can just sort of give a high level, just focus on get an update on the investments, the portfolio performance, and then sort of briefly cover the Tweety Brown recommendation and walk through that, if that makes sense.
Yeah,
and then they'll come on.
Do the market overview that you always do. Why don't we then, and then you can give us a little more information on Tweety Brown, and then let's do them, and then let's just go back, just because of the timing. It's already 6:15 now, 6:16. Maybe we'll look at the portfolio in more detail after we hear from Tweety Brown, and maybe it makes more sense to play it all through at that time.
Yeah, I mean, look, in terms of markets, I mean, I'll just give a sense. I mean, markets have come a very long way in a very short period of time. And I'll just to give you we all know this, but I'll give you just a sense as to how much has happened in the course of 1 year. This is from the bottom in March 23rd of 2020 to March 23rd of 2021. And you can see here a couple of things. One is, and you can kind of see this hand on the screen, hopefully.
Yes.
That the global stocks using the MSCI All Country World Index are up over 75%. The S&P is up over 76%. Small cap stocks, in the case of the Russell 2000, is up 126%. Emerging market, I mean, just down the line, interest rates, yields on, let's say, the 10-year at 1.7 have moved, almost, from one point to the other. Now they've gone a little bit past that, have moved, almost a full percentage point. 30-year Treasury yields in 1 year have moved 100 basis points. Inflation expectations have jumped up. And this number over here just gives you a sense as to how far away from just a standard deviation, how many standard deviation moves that is in a 1 year, relative to, historical returns in 1 year. I mean, we know intuitively these are extreme, but it's really, really extreme. And if you just look at the trailing 1-year return of the just use the S&P 500, at any point going back to 2000, you can see that so in other words, every dot on this line is whatever the return for the S&P 500 was over the prior 12 months, measured backward, and you can see it's the highest it's ever been in the past, going back over 20 years now. And you can see, the 10-year Treasury rates have moved 100 basis points in short periods of time, but this is, it hasn't moved much more than this in this short a period of time. So it's been extreme. We know that, and as you probably remember we've had a number of conversations over this period, but it was our point of view that just the amount, the speed of the stimulus, both Federal Reserve stimulus and the helicopter money, literally putting money in people's pockets, one way or another, they were going to force an economic recovery, even if it meant paying people, just literally putting money in their pocket. And it's very interesting. One thing, to me, if you just look at something like the economy, we don't spend a lot of time looking at GDP, but when you think about recessions, it becomes particularly relevant. It becomes relevant to how markets behave. I mean, you can just see, there's the V. Not only did it bounce back, but it's bounced back and gone above what the trend line was for the economy. And if you look at the past 5 recessions, including this last one, again, you can see the V-shaped recovery. What might be surprising, or just might be, at least for reference, is again, you can see that the economy is now above where it started even before the pandemic in terms of economic growth. You can see how short a period of time from the start of the recession, now to where we are in terms of quarters. And you can see going back to these, the 08 recession, the 2001 period, 1990, 1981, those periods, it took years, and they never, in some instances, in the case of 2008, it was 2 years later, the economy didn't get back to even where it was at the start. So this is pretty remarkable, what's taken place. One thing, though, this time last year, when markets fell as much as they did, I guess the silver lining to it is we adjusted our expectations for returns upward. We're thinking over an intermediate, 7 to 10 years. We use 7 years as sort of our intermediate term time frame. Things have moved so quickly that really with some exception, our outlook for both stocks and bonds from here forward, we have years worth of return now, is once again pretty muted. And again, I'm not talking about this is not going to what we think is going to happen in the next 6 months, with the next year, or maybe even the next couple of years. But it is probably a pretty good indication of what's going to happen over the next 7 to 10 years, just in terms of return. And really, the exception is outside the U.S. and in emerging markets. Granted, more risk, but we do have and have had a healthy weighting to emerging markets equities. We're not predicting negative returns, but we are anticipating lower than historically average returns from equities, far lower than average returns from fixed income. As you can see, just U.S. taxable fixed income, 1.1% per year, pretty low, needless to say. So, it's going to be, we can get there a number of different ways. It's not all that unusual. You've had this conversation many times. It's not all that unusual. We go through these periods where, markets are, somewhat flattish or range bound, and they can actually be quite fertile environments for investing. But I guess I'll put a period at the end of it to say that, to look at the next 10 years and think, well, it's just going to be like the last 10 years. It'll probably be, quite a bit different than what we've seen. These are really charts that kind of, say the same thing. One thing that I think is important to point out, this is coming up a lot in conversations, and is with interest rates as low as they are, and as I just showed you a number of fairly anemic return forecast for fixed income. at this point, should we even have any fixed income at all? I mean, it's not going to, it may even, in the case of, treasury bonds, let's say, after inflation, there's a plausible scenario where real returns after inflation, can actually be negative from such a low. So you think, well, why would I do that? Because I'm almost assured, not to make money. Well, there are a number of reasons. I want to focus on one of them, and that is that bonds still are a diversifier. Michael, I know that this has come up in other conversations and in other meetings as well. And we have diversified the portfolio, and I'll point this out. So it's not to say that that the bond portfolio that the plans have is in the Barclays U.S. Aggregate Bond Index, but as a broad proxy for bonds, there still is a reason to maintain high quality bonds in a portfolio. One of the reasons is that bonds are historically less volatile than stocks, and what this chart is attempting to show here is the combination of things that make bonds, or that give a portfolio diversification from having bonds in them. In this case, 40%, like a 60-40 allocation, and the volatility buffer itself. Lowering the volatility is really the largest piece of it. There are some other we call it decorrelation effect. This is to the extent that bonds and stocks have a lower they can still be positively correlated, but a lower correlation to one another. And then in some cases, although we're not anticipating this to the extent that even they can be outright negative. I guess the broad statement here, with being maybe a little bit less technical than what this chart indicates, is that even if bonds don't do well, even if bonds go down as stocks go down, they're likely to go down a lot less. It gives you a chance to rebalance, and the overwhelming risk allocation in a portfolio comes from stocks. So in a nutshell, it's one of the arguments against just completely gutting a portfolio. If we were only investing money for a really long period of time, and we were going to come back 20, 30 years from now, and there's going to be no money going in and no money going out, I think there's maybe more of an argument. But in a portfolio where there are cash flows, managing volatility to the extent that you can, is important. So again, not to sort of on one hand, on the other hand, I just want to point out that it's a reason why we haven't gone all the way to let's have nothing in the case of bonds. There are things to do, and if interest rates do pick up, or as they have picked up, they can continue to pick up. There's also more. The investment environment actually gets a little bit more fertile. So with that, I just wanted to comment on fixed income. But again, we have, as I'll point out here, and I'm going to flip over going to Tweedy Brown, but we have here a pretty diversified allocation when it comes to fixed income and things that can behave like fixed income. MetWest, yes, it's a core fixed income account, but again, they're pretty cautious. And as you'll see in the performance, they've managed to actually do quite well in a really tough short-term environment. We have emerging markets fixed income. None of that shows up in the typical bond portfolio. Happens to be U.S. dollar, so we're really not taking currency exposure. Double line, again, core high-quality bond exposure, but mostly through mortgages, tends to have a lot less in terms of straight duration exposure. And then J.P. Morgan Strategic Income, a manager who has zero duration in this portfolio.
And again, duration, just for the purpose of the group, means they're less impacted by interest rates going up.
The zero risk duration risk is a measure of their exposure to interest rates. If somebody that has a high duration, the Barclays Aggregate Index, it has, let's say, a 7-year duration. If interest rates go up 1%, you would anticipate losing 7%. it's like a seesaw, setting aside any income. If interest rates go down 1%, that portfolio should increase in value by 7% because of the 7-year duration. It doesn't quite work exactly that way, but
And what you're saying is that
you know,
most of our funds aren't, what you're saying then is most of our fixed income funds aren't affected by that risk of the rising interest rates.
they're
Or less. Or
that's
less,
right.
Less impact.
That if I were to basically, since we have visuals, if I were to take a bar chart and I were to break up what risks affect the Barclays Aggregate Index, 9/10 of it comes from duration. It's an interest rate hedge, let's say, interest rate bet. If I were to take this portfolio and break it up, which I can do, I haven't done it in these exhibits. Some of it would come from interest rates. Some of it would come from its credit exposure. Some of it would come from being, having, lower duration in the portfolio. Some of it would come from, whether credit spreads are widening or contracting. It would look like the sources of return and the sources of risk would be broken up into slivers. Now, having said that, Michael, important to bear in mind, if the market goes down suddenly, and if there's a flight to quality, it also means that we have less buffer in that period of time than we would if we just straight put it into like a US 10-year. But it's a conundrum because it's a very difficult problem to solve because I know we've talked about this, but you can't rely on bonds the way that you used to. But it doesn't mean you've got to, completely got a portfolio of bonds and just take it all and put it into credit and equities.
Okay. So before
there are going to, they're gonna. Well, I guess we'll see them pop on here in a minute or two. I don't think we've seen them yet, but what you'll see here is, and we'll come back to this maybe afterward. But you'll see here where the Neuberger Berman money. So Amanda, that this is what we did, right, to deal with the IVA funds to reallocate it.
Yep.
And then this is just taking it one step further and saying, okay, what are we doing if we were to reallocate? And so what we're doing here is we're just trying to get Oppenheimer and Tweedy to the same level. Oppenheimer is also international equities. They have more of a growth orientation. There's not going to be much, if any, overlap between what Tweedy does and what Oppenheimer does. And Neuberger, incidentally, is a little bit closer to Oppenheimer's style in some ways. Stylistically, they don't own. It's not the same portfolio. So this is a little bit more of a tilt toward toward value. And of course, with IVA coming out, their equity allocation was much more value oriented. So we're kind of trying to address two things at once.
Okay.
Has IVA come out?
IVA is out. And I'll just pause for Michael mentioned something earlier, not to end this part of the conversation on a morbid note, but Charles, who some of you knew and had met, he's the one who managed the portfolio and he's the one who shut it all down. I know we were scratching our heads, but it ultimately ended up he took his own life a couple of weeks ago. Oh. And you may have read about that. And so some of the mystery around, not that we can make sense of all of that. Very, very sad. Many of you had met Charles. He had come actually to a board meeting. So just a horrible thing in many ways, to say the least. So, but wanted to make sure that you all, Michael pointed that out and make sure we didn't leave that out of the discussion.
Hello, this is Tom Sugar from TD Brown.
Oh, there we go.
Hey there, how are you?
Hello.
Hello.
Hey, Jason. Jason, right on time. It's Ross here, and what we'll do is I took the screen off, but I can put it back on. But maybe Jason, if you'd like, I'll let you handle the introductions and walk through things. We have an interactive group. There are a few exhibits here, and I'll put them on the screen when you're ready. But I'll let you maybe take it away from here. We've sort of teed things up. Michael, I don't want to, but before we go, Mike Evans is the chair, and I'll turn it back to you, Mike.
Okay, well, just, why don't you just have, the gentleman from Tweety Brown introduce himself, and why don't we just go right into his presentation? Is that
Great.
fine?
Sounds good.
So welcome to the Cheshire Retirement Board. Thank you for joining us tonight.
Thank you.
Hello, everyone. Thank you for your interest. Well, maybe I'll start. Hello, everyone. I'm Jason Menard, and I've worked at Tweety Brown for 22 years as a sort of a client relationship person, and I'm joined by three of my colleagues. I see two of them, Bob Wyckoff and Tom Schrager, and I think Jay Hill is with us as well.
Yep, I'm on the line, Jason.
Jay, Bob, and Tom are three members of the firm's investment committee that make decisions on our portfolios at Tweety Brown. Today, our plan, I think we have about 30 minutes, and our plan is to introduce our firm and give you a brief introduction to our approach, and specifically the Tweety Brown Global Value Fund, which is an investment vehicle that invests primarily outside of the United States in what we describe as value-oriented equities. In the interest of time, and please, if there's anything, just jump in and interrupt us if you have any immediate questions. In the interest of time, I'm going to give you a little bit of the abridged version of our roots, but I think it's important because it's not an accident that we practice this approach called value investing. Our roots go back to 1920 here at Tweety, so we're in our 101st year here. Our roots go back. We were a stockbroker. We were essentially a market maker, matching buyers and sellers who made trades in what in those days were somewhat obscure, off the radar type securities. And that business got the attention of a very famous investor, a guy by the name of Benjamin Graham. Graham, as many of you may know, was a professor up at Columbia University. I think he's most famous for being Warren Buffett's teacher and employer at Columbia. Graham wrote books. He wrote this book, which Warren Buffett calls the most important book ever written on investing, The Intelligent Investor. He wrote other books, and he put his investment theories to practice in a business called Graham-Newman Corporation. And if you've studied Graham, his teachings, his writings, we think it boils down to a few simple ideas. And it's the ideas you're going to hear repeated amongst our group today. Number one, a stock is essentially, it's not a piece of paper that trades around, but it's a fractional interest in a real business. And Graham essentially felt what people should try to do is try to understand what common sense values are for those businesses. And what Graham tried to do, he essentially felt that there were two prices for every share of stock: the publicly available price that we would all see on our screens on any given day, and what Graham referred to as the other price, or the intrinsic value of the business. And for lack of a better description, intrinsic value would be if a knowledgeable buyer and a knowledgeable seller in an industry got together and that business was exchanged outright, what would be a common sense price that those two rational business people would agree upon in such a transaction? And what Graham tried to do is come up with a common sense per share value for that stock and buy it through this irrational place called the stock market at what he felt was a big discount to that common sense intrinsic value. If he thought a stock was worth 100, he was trying to buy it through the stock market at $65 or less. This is essentially what we're trying to do at Tweety today. So quickly back to our history, when Graham was looking for these bargains, he fell upon us as a broker, and we became Ben Graham's primary broker and worked as his broker between the 1930s and the 1950s. This relationship was so important to us, we literally moved our offices next door to Graham. We got to know Graham, and most importantly, we got to know how he thought about investing. When Graham retired in 1959, he offered his business to Warren Buffett. Buffett declined. I think you all probably know his amazing story. But there was another young analyst at Graham-Newman who came over and joined Tweety Brown when Graham retired and was responsible for transitioning our firm from what had exclusively been a broker into being a money manager, managing managing equity portfolios and employing Ben Graham's discount from intrinsic value techniques. So that's a little bit of our roots and our history. In the interest of time, I'm not going to go into all of it. You should know that we've had outside clients. In 1959, we started this first portfolio at Tweedy. We've had outside clients since 1968. We registered as an investment advisor in 1975. We served as Warren Buffett's primary broker and purchased all of his shares of Berkshire Hathaway when Berkey was an ailing textile company up here in the Northeast. So these people, Graham, Buffett, one of our analysts joined us from Charlie Munger's firm early on. They shaped, we once wrote in one of our papers, on the shoulders of giants. These people were going to shape how we were going to think about investing for many, many years to come. The portfolio I think that you're considering is a foreign portfolio, and we've been investing outside of the United States since the 80s and really began managing distinct, discrete international and global portfolios really beginning in the 1990s. So we've been at it for a while. We've got track records and the information that we've provided to you that sort of shows the long history of this approach, and it's been successful. Last couple of things I'll say in the interest of time. We're still a relatively small firm. We're 46 people here at Tweedy Brown. We have one approach. It's value investing in a few different flavors, and global, international, and global high dividend. We have two committees. We have an investment committee of 7 members. That committee, we make decisions as a group. There's no star at Tweedy Brown. The star is the process that we were so fortunate to inherit many, many years ago. Our process guides everything we do here. But we have a 7-member committee that makes decisions as a group. They're supported by another 5 members on the investment team. We have a management committee, which consists of 4 members. The 3 gentlemen, Jay, Bob, and Tom, are members of that committee, which makes business decisions. We're managing about $13 billion in assets at Tweedy today. And the majority of our assets are in portfolios similar to the one that you are considering. And the last thing I'll say is we eat our own cooking. If you all come on board, we'd be honored to work with you. You should know that the people at Tweedy are also significant investors in this vehicle, and we think that's the ultimate truth serum to keep us focused on the right things, which is long-term investment results. I'll stop there. I've left a lot out, but I want to just give you a little bit of a flavor of the firm, and eventually we want Jay to talk a little bit more about what we do as investors and dive a little bit deeper into that. But maybe I'll stop for a second and see if there's questions.
Okay, so if there are no further questions, I'm going to dive right into the investment process.
Jay, were there no questions, Ross? Are we good to go?
Yes.
Good to go.
Okay.
Go ahead,
Sorry,
Jay.
Jay.
Yeah, so look, the goal is to buy companies at 70% or less of a conservative estimate of intrinsic value. With intrinsic value being defined as what would the business be worth if the company that we're studying, their CFO picked up the phone and put the company up for sale tomorrow, right? So what would the private market value would accrue to the shareholder? So we appraise value by observing M&A multiples paid in real world transactions for different businesses. And I would say the best analogy of our investment process is if you were looking to buy a house or if you were looking to sell a house, one of the most important things you would want to know is what have similar homes sold for recently, right? You'd want to look at comparables. That's what we do at Tweedy Brown. As an analyst, I probably spend 25% of my time just tracking M&A deals in various industries, and then trying to find similar companies in the stock market that are trading at large discounts to those observed purchase price multiples. That's really the essence of what we do. And we do that by studying M&A fairness opinions, studying merger press releases, and studying M&A deal conference calls. In certain instances, we identify a very cheap stock and M&A comparables don't exist. And in those instances, we tend to use rules of thumb. I've been at Tweedy Brown for 18 years, and generally M&A multiples are heavily correlated to the organic growth prospects of the business, the returns on invested capital that the business generates, and then the stability of a company's earnings over the cycle, particularly during recessions. And then if there's a fourth factor, it's interest rates, right? Lower interest rates have generally led to higher purchase price multiples being paid. And that's certainly something that we've observed over the years at Tweedy Brown. The other thing that I want to mention is that each new idea at Tweedy must pass what we call a two-part test. So the first part of that test is the stock cheap, relative to comparable M&A deals that we've observed? That's really looking at relative cheapness. The second test is the stock cheap just on a standalone, independent basis? That's looking at absolute cheapness. And the reason that we have that second criteria is that we recognize that, look, sometimes buyers overpay. And frankly, if we can't understand the purchase price multiples that we observe, we're not going to just blindly extrapolate purchase price multiples that we don't think are sustainable. So it's got to be cheap on a relative basis and on an absolute basis. In terms of idea generation, the vast majority of the new names that the analysts have come up with from Tweedy Brown start from quantitative screens. We run a variety of screens looking for measures of quantitative cheapness. The one that I really want to point out that I think is different from us versus other value managers is we're very risk averse when it comes to debt leverage. We typically never buy a new stock that has net debt to EBITDA in excess of 2.5 times. What you really need to understand is that the vast majority of the companies that we own are investment grade rated, and many of the stocks that we own actually have net cash. So we insist on balance sheet strength. And then one other point that I should mention is that we're big believers in the efficacy of insider buying. This is insider buying is when management of the company or the board of directors are reaching into their own pocketbook and they're buying shares in the open market using their own money. We believe that's a very positive signal. And there's lots of empirical academic studies that have shown that if you combine insider buying with quantitative cheapness, that's a recipe for long-term outperformance. In the interest of time, I'm not going to go through the rest of our sort of due diligence process, but the one thing that I do want to point out that I think all of you should know is that the types of stocks that have the quantitative criteria that get us excited, that get us trembling with greed, right, have problems. There's a reason why the stocks are selling off in the market. There's a reason. It's very typical for us to be buying a stock where the stock price has gone straight down. And there are well-known reasons. And a key part of the analyst jobs at Tweedy Brown is to identify those key risks and make judgments on whether or not we think those risks are temporary in nature, i.e. cyclical, that will likely pass with time, or are those risks more permanent in nature or secular? Ultimately, if the analysts can come to the best conclusion that they can, that the risks are cyclical and will likely improve with time, the analyst will write up an investment recommendation. That report will get sent to the rest of the investment group. And then we have a 7-member investment committee that makes a decision on whether or not to buy a new stock. I'm going to stop there so we can have plenty of time for questions.
I have a question. Hello, I have a question.
Yes, sir.
Following what you're saying, what's your turnover rate?
Jason.
Yeah, it's been pretty low. Historically, our average holding period for a business is between 5 and 6 years. So that's between 15 and 20%. What value investing is long-term investing. And if we're with a business that grows, we can own businesses for much longer than that if a company grows its intrinsic value. But
also, to follow up, when you buy a business where there are some clouds on the horizon, those clouds will not lift very soon. That means it takes time to turn around the business. So that's another reason why it takes some time before we exit the stock.
But that's
they will lift immediately.
But that's also one of the reasons why we get a pricing opportunity in those shares, because most investors' time horizons tend to be much shorter. instant gratification is the rule of the day in public equity markets more often than not. And investors don't often look beyond 6 months to a year. We're willing to look further out. And if you're willing to do that, you can get a really attractive pricing opportunity going into the security. And as you can tell from everything we've been talking about here today, price matters to us. It matters dearly. And I wanted to say one follow-up thing to what Jay said. There's two other ways we reduce risk in the portfolios that we manage. We believe in diversification, as did Ben Graham. So this portfolio that you're considering is diversified by issue, by industry, by country, and by market capitalization. We're willing to own small companies, medium-sized companies, and larger companies. It all depends on price to value. Today, the portfolio has a larger capitalization orientation because that's where the value has been showing up in recent years. But even though we're diversified, we don't look anything like an index. And if you're going to have a shot at adding value to the market, which is what we do, you can't have a portfolio that looks like the market. So our industry weightings, our country weightings, our individual issue weightings are radically different from the overall market weightings. So there's going to be times where the market's outperforming us. There are going to be times when we're outperforming the market. But over a long measurement period, we've been able to add considerable value. There's one other way we manage risk in the portfolio. And in this portfolio that you're looking at, we hedge the currency exposure of this portfolio back into the US dollar. So what we're trying to do is strip out currency risk. We go abroad looking for securities that are undervalued. We understand that extremely well, but we have yet to find anyone that can predict the verities of currency fluctuations. And so to us, we learned long ago that at virtually no cost, through hedging, using forward contracts to hedge foreign currency, we were able to set aside the currency exposure in the portfolio. So when you earn your returns in this fund, your returns are coming from the underlying securities and not from currency speculation, if you will.
I have a two-part question for any of you. The first is, what's your allocation, just generally by, part of the world, Europe, Asia, emerging market? And the second part of that is, after COVID, with different countries handling COVID better than others and some worse than others, have you had to make fundamental changes to that, allocation, that country allocation or region of the world allocation?
Ross, am I able to share the screen? Oh, you've got it there. You're ahead of me. I think there it is.
There you go.
So, this fund, our allocation to any particular country or industry is going to be a function of the bottom-up process. It's not by a target, it's wherever we're finding the cheap stocks. And so what you could see here, it's primarily developed markets. And we do have very meaningful exposure to Europe. I haven't added it up, but I think it's about 68% of 65 to 68% of the equities are in what we would describe as European equities. A number of the new names that we've added over the course through the pandemic, we have found a number of stocks in Asia, a number in Japan, a couple in China. So it's a bottom-up stock by stock process. Our emerging markets exposure, which I believe today is about 10%, we're going to try to invest in places where we think, as a US-based investor, there's some level of contract law where our rights could be enforced, where there's reliable accounting information, a fair share class. If we have those things, we will invest in an emerging market. And today that number is about 10%, but with the intention of being repetitive, the allocations are simply a byproduct of where we're finding cheapness.
Your question, maybe I can start and my colleagues can chime in. Your question about COVID and the impact on allocations and where we invest. There's no question, if you went back about 4 or 5 months ago and you were looking at the growth predictions by the International Monetary Fund, they were predicting much faster economic growth outside the United States. Europe had a much deeper bottom than we had, and the economists were expecting a bigger bounce off that more extreme bottom. But we all know that over the last 3 or 4 months, the vaccine rollout in Europe has been somewhat erratic, halting, if you will. It's picking up as we speak, so that those predictions for faster growth outside the United States may be delayed a bit. But there is this expectation that coming off what was a more difficult bottom, particularly in Europe, that you're likely to have a bigger bounce back economically than we're going to have here in the United States. But the vaccine rollout last November in the United States, when it was announced that we had vaccines that were 95% effective, that was a huge boost to the kind of investing that we do, value investing, because the idea with these very effective vaccines, we could count on a very, very robust economic recovery coming out of COVID. And when we all got untethered from our machines, got back out into the real world economy, that this strong economic response would really benefit more traditional, older economy, value-oriented equities. And empirically, when you have a strong economic recovery coming out of a very difficult time for the economy, value tends to perform very, very well in that kind of environment. So in November of last year, when the vaccines were announced, we had perhaps our greatest month in terms of performance in 20 years. And that was true for other value investors in the marketplace. And over the last 6 months, that has held. So you're beginning to see this rotation in public equity markets out of tech, out of big tech, and more into value. And if that holds, our fund should be a beneficiary of that. Not only are we value oriented, but this is an international vehicle. And equity markets outside the United States aren't dominated by big tech like the US equity market. Let's face it, over the last 10 years, it's been all about big tech. And we think there's a rotation going on in the market. We'll just have to see. It reminds me back in 2000. I remember, value investing went through a tough period of time for 3 or 4 years prior to the bursting of the tech bubble in March of 2000. But I remember those days. And a lot of what you read today, people like to talk about, well, that was because back in those days, these were internet airballs, pets.com, e-toys, we all remember those. But I remind people that it wasn't just those kinds of companies. Some of the greatest companies that were in existence back then also fell completely out of bed. And that was companies like Cisco, Microsoft, Hewlett-Packard, IBM, Intel. These were companies that had a tremendous run-up up until 2000. And then when the technology bubble started to burst in March of 2000, between March of 2000 and late 2001, they sold off between 50 and 80%. I'm not predicting that this time around. We don't know what's going to happen, but there are similarities. Valuations have been extraordinarily high in growth stocks and particularly high technology stocks. And that typically doesn't last. It typically flips, and we're seeing evidence of that over the last 6 months.
I'll ask one more question. I don't know if there are other questions, so I'll reserve anything
Ross,
have
I
to
just have
ask
one
if
more
I have
question. It looks
Yeah, go
like
ahead.
when I just took that quick look that the U.S. exposure right now, it's a global fund, was only around 10 or 11%. Is that typical of this portfolio? Is it just because the U.S. Averages, the U.S. had done so well in the short term, there were just better values in Europe and Asia, or does this portfolio in general have a largely global, not global, non-U.S. bent?
The fund, Tweedy Brown Global Value Fund, is really run as an international vehicle. You probably, just a little history might be helpful. We named the fund back when we launched the fund in the early 90s.
Okay.
And we named it global to allow for the flexibility at the advice of the lawyers. But the intention was always to run it as an international vehicle. The name global today, as you accurately point out, typically means much larger representation in the US. We're running it as a foreign fund. The handful of US stocks we own, for the most part, tend to be businesses that are global in nature. So think about a company like Johnson & Johnson, which you recognize as an American company, has over 50% of its revenues generated outside of the US. Similar could be said for a company like Alphabet that has a huge chunk of its revenues outside of the US. So if we do own a US stock in there, not every single instance, but the vast majority of any
There is one
allocation
exception in that, which is Berkshire, which for historical reasons we've owned in the fund.
But you
have on the domestic side stocks also like Alibaba that are quoted in the U.S. Stocks like Baidu that are quoted in the U.S. but are really Chinese company. Yeah, and the proportion of U.S. stocks in the portfolio that are truly U.S. stocks has never been higher than 10%.
Okay.
Yeah. So but the name is sometimes
You're
misleading.
right, and we're having a debate internally about this. Why do we call this global when it's international?
It's
Makes
come up
no
twice
sense.
in 2 days now, so I'm on the side of changing the name.
No, that's fine.
It won't change anything that we do and how
Yeah,
we
it's a very good question. It illustrates the debate we have internally about how we should call this fund.
Every 100 years, you make a change.
Yeah.
Right. We call that operating on Tweedy time.
That's right. I think I may have you've heard this anecdote before, but maybe it was Chris. I heard it. Seth Klarman said it about Tweedy Brown, and Jason, I mentioned it to you, and I think it was maybe Chris Brown that said it. That somebody came to interview at Tweedy Brown, and they said to someone there that at Tweedy Brown, at most firms, you can tell if the market's up or down based on when they walk through the office, and at Tweedy Brown, they can't tell if the market's open. Or something to that effect. As an anecdote. Can you? I'm going to steal an extra minute or two here, if people don't mind, and I just would hope if you could talk. Even Buffett himself has shied, although it's big news if he goes outside the U.S. Value investing outside the U.S., value investing outside the U.S. I mean, something prompted you at the time. The early 90s was probably pretty early relative to others, even though it seems like it wasn't that long ago. Can you maybe just comment on not just we understand why value investing, but why international? Maybe even in light of the fact that so many of the forefathers, so to speak, have intentionally stayed out of international. So it seems like a contradiction, maybe.
Yeah, let me take that because I'm intimately related to that move into international. I was hired in the late 1980s, essentially to try to guide a little bit the firm on the international side. Will Brown hired me. He said, "You're a goddamn foreigner. Start looking at foreign stocks." I have a facility with a couple of languages. At Tweedy Brown, we have a tremendous facility with language. And although that is less important nowadays because most annual reports come in English, it's important from a cultural affinity standpoint to have that. And at that time, accounting standards were very different There were companies in the UK who were trying to show you much better profits than they actually had, and companies in Germany and Switzerland who were trying to minimize the profits they were showing you. So you had to figure that out, and it was a process that took us as a firm a number of years. So between 1991 and 1989 and 1992 was really a learning process for us, trying to learn the different cultural differences, economic differences, accounting differences, and so on. So by 1992, we started investing in an organized fashion. It was much more when we started. The reason we started there, it was because it was a treasure hunt. The majority of the companies that we looked at had accounting systems that were conservative. One of the reasons, and that may bear on the debate now that you have in the US, is because in a lot of European countries you had wealth taxes. So there was no reason for a stock that was controlled by a family to maximize value in the short term. As a result of that, they didn't want to show a lot of profits. The second reason was banks were very important lenders and investors, particularly in Germany, in companies, particularly in Germany and Japan. And they cared more about the repayment of the loans rather than showing profitability at the bottom line. All of this created, if you thought about it longer term, an opportunity to buy streams of income at a highly discounted price. And that was why we started.
I would just add to what Tom said that equity investing outside the United States wasn't as well developed in Europe. So you tended to have much greater pricing inefficiency. There was more emotion when people were involved in markets. You got more herd behavior, which would drive prices up or drive prices low. And so with this greater inefficiency leads to more bargain opportunities. And in the United States, you can imagine equity investing here is highly evolved, highly sophisticated, multi-styled, lots of value investors and bargain hunters. That wasn't the case outside the United States. And
it's still less so. It's still more inefficient. It's still, we have less competition. So it's still a good place to go and hunt.
Very good.
Terrific. Thank you. Mike, I'll turn it back. Do you have anything else you want to make sure we cover?
No, I know that's great. I appreciate, the whole team. So thank you. That's very much appreciated by our team to have your entire team participate, or a good chunk of your entire team. So thank you for that.
75%.
There we go. It's a good number. So thank you all. Great job.
Take care.
Thank you for your consideration.
Good evening.
Bye.
Bye, everyone.
Thank
Thank you
you
so much.
Thank you.
Long
Ross, it's obvious, but and I'm guessing most of you will, or all of you will agree. I mean, it really gives us a lot of confidence when we have a presentation like that. You can show us bar charts and numbers and all kinds of stuff, but it's very real when we get, including the gentleman with the thicker accent. That's the and I mean that with no disrespect whatsoever, but just it gives you a flavor for who they are and what they do. And so I thought that was pretty impressive. Any other comments from the group?
Yes, I'd like to comment. Ross, I think you've done a wonderful job for us. I think that was a horrible presentation. The gentleman started off with, we're all investment people. We know what's going on. We know how things work. They were asked 3 questions. They only answered 1 of the 3. I was not impressed with that at all.
With the okay. Does that make you less enthusiastic about investing with them?
I'm going on Ross' recommendation. He's been wonderful for us. He's done the job the way they should be. But I think they should have known we were all investment people. They should have presented it that way.
Dennis, what did they just to make sure? What did they what did they miss covering? I mean, other than their style of presentation.
Well,
I want to make sure.
The first 15 minutes was history about the stock market. We all know about the history of the stock market. We don't need that. We want to know about the company, how they do things, and how they think. I asked them about turnover. They never answered the question about turnover. Well, we might be 5 or 6 years. What's your turnover rate? They never answered it. That was my concern with that.
Yep.
Do you have a turnover rate?
I think they did answer that question. I heard 10 to 15% typically. Probably a moving target, but I thought they did answer that.
Okay.
And it did show in the materials that it's around 14 right now. But I mean, that we appreciate all input because we all have different. To me, I'm a history person, so I like history, I guess. You know what I'm saying? And I'm not trying to argue with you by any stretch, Dennis. We just all come from different aspects. And remember, our town council rep and our firefighters and our police officers aren't investment people. So that's something else to keep.
Mike, I'm not arguing with you. That's my observation.
No, I get that. I appreciate that observation.
I'll go along with what Ross recommends.
And I also agree with you, Dennis, that Ross and his team has done a great job of putting, folks in front of us.
I think it's I think it's a fair critique. Go ahead. I'm sorry, Michael.
This is a question. Did Tom Izzo ever join us?
Mark.
Tom has. I'm sorry, Mark is.
Ladies and gentlemen from Michigan State dialing in.
Exactly. The head coach of the Spartans. Excuse me, Mark.
I'm here. Can you hear me?
Yes.
Hello?
We can hear you now.
Okay.
Okay.
Sorry, guys. I just got on. Sorry, but it wasn't a good
fine.
night. So.
No, that's fine. No, welcome and nice to have you here. So
sorry.
Why don't we from here? Any other discussion on any other comments on Tweety Brown on?
Mike, as we go, I can maybe talk, just add a little bit to it as we go. So there's some context to that conversation. I'll maybe put the recommendation back on the screen, but I'll just reference Dennis. I think it's a fair criticism. I've had many discussions with them, and I've had even going back to early conversations. When you have 4 or 5 people, kind of talking, and especially, it's hard to get your arms around. It's like, well, who does what? I know what Jay's job is. I know what Tom is doing. But what they don't, I get the another way and a critique, or maybe a point of reference, even to Jason, who's there to articulate, is to be a little bit more of a of a leader in the presentation and walk people through and say, hey, look, here's our background. Let us show you. I mean, they could. And I also want to, in fairness, what I actually had them take, they had sent like 50 pages worth of materials, and I said I don't want to put 50 pages worth of portrait style reading materials. If you go in there on their website, which I invite you to do, it's white paper after white paper after white paper. I mean, they have not, when they say they have not changed that website since the World Wide Web. I mean, they're very a little dusty about those things. So I can totally, especially if it's the first time that you've heard from them, as it is. See that it'd be really hard to understand. Okay, I got the background, but what is it that you all do? So, I would agree with you, Dennis.
Yeah. The other thing, and again, I hope I'm not putting you on the spot by any stretch, Dennis. That as we started to run out of time, run out of clock, the more I think about this, and I guess I'll agree with Dennis a little more. If there's one thing missing, I would have liked to. I like stories. Like we bought Johnson and Johnson at because of such and such, because I don't know, they had a scare over. Remember that whole thing? And I don't know if that's why they bought it. You know what I'm saying? Or some anecdotes, but
fucking assholes. Sorry.
Oops. Whoops.
I am in.
That does not go
I'm
to
sorry, but I'm in a traffic jam of all traffic jams here, and I'm losing my patience. So sorry, guys. I thought I was on mute. Sorry.
Sorry, Mark. I just called you Tom Izzo. I just made you the coach of the Michigan State.
I was going to say Tom Izzo back on mute. Sorry.
Yeah, exactly. No, it's all good. It's all good. The world of and I'm glad they clarified global because that was going to be one of my main questions: is why are we replacing an international portfolio with a global? And then I'm looking at it and it shows 10%. So that was anyone else, is Paul there, or any of the police officers? Anyone else have any, or certainly David? Anyone else have any comments or questions about Tweety?
Well, just from my point of view, I like the value approach. I like the also the Oppenheimer growth approach. It sounds like more of a barbell approach to growth versus value. It's kind of where if the pendulum is swinging to value, we're kind of hedging our bet. I like that approach, but the getting back to the turnover ratio, what that tells me about the fund is they have the courage of their convictions.
Right.
They're buying stuff and holding on to it, but they're going to have to do an awful lot of research to figure out if that's what they really want to do, because they don't like to change their mind. So I think that's a very good sign. So thank you, Ross. I too appreciate everything you do.
You're very kind to say it. Thank you. So maybe what I'll do, Michael, is I'll just go back on the screen for a minute here, and we can maybe move from that and just sort of look at things at a high level, and talk from there. So you'll see here that within the in the larger pool, what we're recommending here in this May column, which is to take the Neuberger out, add a little bit, and we end up with the two even. And I'll just comment, just add one more piece of context. So you'll probably remember that when we took the IVA out, some of what we were doing here, we said here that it would be it was not, that there would be more to follow. Some of what we're doing here, I actually think, is more to follow, but not entirely. The reason I say some of it is that if you remember, IVA, $1 invested in IVA was probably somewhere, even at that point, probably closer to 50 cents, but usually around 60 cents invested in equities. And in a strategy, their equities would have looked, very much, like even a Tweety's equity portfolio. Obviously not 100% overlap, but stylistically in many of the same holdings. So by going in very close to 1-for-1, it's actually we're actually kind of adding to international value. We moved some money. We did move some money into the fixed income, in terms of rebalancing. And I do think, and even within some of the inflation sensitive, I do think there are things to do that we are working on. They're not things to do today, but there are things to do, we think, in private markets. And so I think that will be maybe I'm previewing things to come possibly at upcoming meetings. So we're not totally done. We're never done, but we're not totally done with what I think we're going to end up wanting to recommend. But I think from an equity standpoint, this helps get us where we think we would like to be, from an allocation standpoint. So anyhow, our recommendation, on this page is to, redeem from the Neuberger Berman International, place the most of that money with Tweedy Brown, add $370,000 to Oppenheimer, just so that we have an equal amount in the two managers at the time that we do it.
Okay. So if there's no further discussion on Tweety, and then once we do this, I'd like to also just do a quick review of the rest of the portfolio. We can,
Yeah.
And Jim, I know we've done it before, but just maybe we move the investment policy to August. I know we've moved it before, but is that okay for this meeting?
Yeah, it's, I mean, I wouldn't have a problem with that. Ross, I don't know if there was anything pressing on that from your perspective.
It's not pressing. Basically, just as a sort of a reminder, I guess, and an update. One is this is really a consolidation of what's already there, simplified in terms of the document itself. So as a material, in terms of materiality, it doesn't change anything. So whether it's today or then. The other thing is, I know that from last meeting till now, we have a group internally from a compliance and legal perspective that goes through, does two things. One is they make sure that, they review local ordinances, any applicable laws, make sure that, it's good, and they've passed their blessing. And part of their blessing is there's a group above us that monitors, adherence to investment policy. So all of that information gets uploaded into a system, and it's part of what we monitor. So, those were things that from the time you saw it last till now, I wanted to make sure that before we made any final recommendations, whether it's now or at the next meeting, that, we were that had been passed on, internally here, and everybody thought it was good to go.
Okay. So if there's not any further discussion on Tweety, I make a motion that we do follow Ross's recommendation on page 19 of the materials of moving approximately 6.3 million out of Newburgh Berman International, in reallocating approximately 370,000 to Oppenheimer, and of course most of it to Tweety Brown, approximately 5,966,000. Is there a second?
I'll second it.
Okay, any other discussion or any other comments on that? Okay, all those in favor? Aye.
Aye.
Okay,
Mike, I'm gonna abstain. I'm gonna abstain because I did not see the material, and I don't want to vote on something I didn't see. So
No,
I think you have enough votes to carry it.
no, and I appreciate that. I appreciate that you making the effort too, so thank you. Okay, so Ross, why don't we just wrap up the meeting, obviously the markets, we had a good March. April continued strong, and May we've had a little bit of pullback, but is there anything in particular that you want to highlight on the portfolio itself?
No, I'll give you a little bit of an update. I mean, the materials, just because we sent it out a little early, is through March. And you can see the marketable, setting aside the illiquids, up 247. Amanda, where are we? I think that's probably closer to, you said me earlier. That is, so probably closer to about 6.25 as of yesterday. So maybe a little bit lower than that today. But
okay, so we've made more in April and beginning of May than we made in the first quarter. Are the alternatives? Obviously you can look at numbers, and the traditionals did a lot better than alternatives. Is that just sort of a trend with the markets in general? I know the alternatives are more of a hedging mechanism, and obviously most of them have the names hedge funds. Is that basic concept that hedging doesn't work as well when markets are doing better?
Yeah, I mean, these are, it depends when you stop.
To oversimplify, because obviously fixed income had a bit of a lag in the quarter also, and equities did very well.
Yeah, I mean, I think it depends where you stop the clock. You know, we've had such a move up. I mean, you just look at just here, you just go down the list without even, you know, Hamlin over the last year. You know, Hamlin's up 60%, Clearbridge up 55. You know, FPA. You know, here's a manager who's only half the time half invested. You know, up almost 55%. You know, Neuberger up 50. Oppenheimer. I mean, it's just. You know, it's just, I mean, yeah, their longer term numbers are also good, but these are numbers I in some ways, I hope I don't see these numbers again, because usually they come off of bad times, but you can even see in other areas. I mean, bonds have been challenging. Bonds have been, you know, down this year, flat over the last year. And yet you have, you know, even bond managers, you know, either not going down as much and even up over that time frame. So you've had that. And then, you know, alternatives, it's a bit of a mixed bag. I mean, the beginning of this year was, for a couple in particular, you know, you remember GameStop, all the casualties of GameStop were in long short, and you know we have Pointer and TPG who are long short managers, and you know, whether it was GameStop or it was just shorting in general, I think it was actually the worst month that anyone had tracked in you know, for shorting stocks, which is typically the flip side of those portfolios. You know, we were seeing things were just wild, even though, you know, they still have pretty respectable, you know, returns over the past year. Again, you have, you know, funds that are hedged and have, you know, lower market exposure. So, you know, when you kind of sum those things up, I mean, it's, you know, in alternatives, typically in this category here, that we have the hedge funds and so forth, you know, two things to keep in mind. One is that it's really idiosyncratic. So I told you what the stock market did, you know, hopefully, and in some cases the bond market, hopefully you would not be able to guess what the alternatives did. It's much more idiosyncratic and the strategy, and that's intentional. So yes, Michael, typically in a, you know, the highest returning markets, and as you see from a, you know, going back over the last 20 something years, it is the highest returning market. So it's going to be a little bit more stretched in terms of not keeping up. And that's just because they don't have 100% exposure. Some of these investments are much more like fixed income in some ways, not from an income standpoint, but they tend to do better in tougher environments. It's been a tough environment for fixed income. And as it turns out, the portion here that tends to be most diversified, you know, some of the, you know, Pointer, Ironwood, in some ways, TPG, were diversifying equities. You know, PIMCO All Asset, Graham, Abbey were really in a lot of ways diversifying fixed income, and it's been actually one of their best periods there. So they've done, I think, pretty well. I just think it's really that one January month, and you know, we'll say I think that'll begin to look even in that number that I gave you includes actually an excellent number for Pointer and TPG. You know, in that 1 month. So it's a little bit of a when you stop the clock type scenario, but they're all set up well.
Right. So there's none of those. And we haven't done anything in the liquid area. Are there opportunities in there right now?
Yeah. So I think we're gonna see some. We've already started to see a little bit. I think when these come through, we'll start to see some decent write-ups, you know, in terms of, you know, increases in values. What I'm noticing is that some of these folks, you know, because they tend to the term that we use is they mark the books. In other words, they say when you get a statement from a manager that owns IBM, you know what the price of IBM is. A lot of the illiquids are really just, you know, private market, third-party estimates of value, and they tend to be pretty conservative. And then when they sell something, and we've seen some more realizations coming in, and they're getting big markups because they've been conservative up to the point that they sell. So, you know, in the case of Oaktree Strategic, that's actually now starting to wind down. And so, you know, this is a private credit portfolio. You know, we don't have a quarter, you know, the most recent quarter, but that number I think is going to get marked up. That's going to come out. We're going to look to one of the things just in preview, as I mentioned, that we're working on is to look to start to replace that. I think where we're going to end up going, again, is going to be more within illiquids on the credit side, because we think that we can earn, you know, reasonably solid, you know, returns, you know, potentially even double-digit type returns with income with a pretty good margin of safety in terms of how those funds invest, and it lines up well with some of the things that we want to do. It also lines up with the fact that we're going to see that Oak Tree Fund, it's starting to wind down. And as you can see, the percentage of illiquids relative to the portfolio has now started to come down as well. So now we can start replacing some capital here.
Right.
But net, yeah, I mean, it's, you see I would look at the marketable number, for 1 year, just because this number has a lot of zeros in it.
It always has
but,
zeros.
Exactly.
Yeah.
But net, things continue to do well, and the VIBA, firefighters, OPEB, those are all, chugging along as well. Smaller portfolios, but not unimportant to see that those are doing well. So that's, I guess in a nutshell, that's where we are.
Hey, anyone else have any questions about the overall portfolio? It's a lot more fun to look at this when markets are up than when markets are down. Obviously, right, Dennis and Paul, from being in our
Yes.
business, right? It's a lot more interesting, right?
Yep.
What's the line? We make more money when the markets are up, and we earn every dollar when markets are down, or something like that.
Well, there's another line that says you make your money when markets are down, you just don't realize it at the time.
Right, exactly.
And I do look. I mean, it's an enormous snapback in a very short period of time. There's it's about as confusing a market as we could probably come up with, right now looking forward. So, I think it's good. Yeah.
We talked this before. Arguably, the stock market is further ahead now than it ever would have been if there wasn't a pandemic. As with no disrespect to any of the health of any folks or anything, or any of the tragedies of life, but that's probably the most insane part of this whole time period.
Yeah, I mean, one thought is, if you think about it a little bit, is that when you put this much money, you flush this much money into a system, it's going to go somewhere, and it's one place that it's going to. And we saw it in 2008. This is multiples of 2008. It's gone in some ways to asset prices, in a lot of ways to asset prices. Money's come into the markets. Interest rates, even though they've come up or have been low. It's probably an accident in some ways, in trying to keep people in their homes and keep the economy going. The fact that the stock market went up, is an interesting byproduct, of that. But there's you talk about inflation. There's been inflation in asset prices. There's also been inflation in the cost of not just the things that we see every day, like gas prices lately, or lumber prices going up 150%, or whatever it might be. But the cost of retirement has gone up a lot. You need a lot more money now than if you're getting interest rates that are paying you 2%, then they're paying you, then you were getting 5%. You were going to retire on it. But I think some of that may have gone into into asset prices. So they made a key point that if interest rates are low, pushes the prices of stocks up. If interest rates have started to come up, we're starting to see some of that rotation, and it's one of the reasons we want to tilt a little bit more toward value. I mean, if you put stocks in the context of bonds, think of technology, high growth companies. It's almost like long duration bonds. So they're very sensitive if interest rates are lower. If you think of value stocks, almost like shorter duration bonds. Companies that are earning money today, that are longer term prospects, the trajectory isn't nearly as steep. And that, of course, that trajectory is in people's minds. Nothing's assured. So, if it very well could be, what's going on in that rotation is just the market is kind of starting to reward, value stocks. It hasn't been that way for the past 10 years. but it's never the same.
Anyone else have any questions or observations about the overall portfolio?
I guess, Ross, I think you mentioned that we might be looking at potentially, in coming meetings of replenishing some of those illiquids.
That's right.
Yeah.
That's right. Yeah. I can spend a minute on it if it's helpful. Basically, there's a let's say a large world of what's called, I'll call it, broadly speaking, private credit. And it sounds like a fancy term for, but if you think about public markets, you can go in just like stocks. You can buy stocks on an exchange. You can go buy bonds that are out there publicly traded. There are a large variety of different types of, the companies that go to borrow. They may not go to the public markets. They may go to the oak trees of the world. And you remember, I think they even came and spoke back when we invested with them a few years ago. They will go to them, and the oak tree or other, or Blackstone, or their business called GSO, or Ares is another name. Some of these names that you may hear about or read, or Apollo. These are very, very sophisticated organizations when it comes to underwriting loans, and they tend to do a very, very good job of protecting themselves and therefore the investors as lenders. So and it could be, sometimes it depends. There's different varieties, and so what we're focusing on, what we focus on when we look at private credit are more niche-oriented strategies. When I say niche, I don't mean necessarily small opportunity sets, but someone who specializes in something. They specialize in a particular type of lending, and so they're not sort of at an auction with a bunch of other people kind of bidding up a loan, and they may own that entire loan. And if something goes awry, which typically it does not, because they're building in all sorts of protections, but they're going to be very, very senior in that, as a lender. And this area has grown because really out of 2008, this sort of disintermediation of banks. You don't go, nobody goes to the bank anymore and says, I want to just go get a loan. All that stuff, a lot of that stuff came off the bank balance sheets. Where did it go? It went out into, these alternative investment managers. But, Oaktree, Oak Tree's a publicly traded. I mean, these are blue chip, type firms. But the past 10, 12 years, there's been, that's really where all that has gone. It's nothing new. It's just that, it's being done by private organizations, but in a vehicle that pension funds and endowments, institutional investors will invest in, and it's not being done, as much. Banks are basically just conduits at this point. They're syndicators, even if they're at the table. So actually pretty vanilla. When there's nothing in the least esoteric about it, actually, other than it's not quoted in the on the screen every day. It might not have a CUSIP number, but when you read about a company getting bought out or a private equity fund, they'll borrow money. Where do they borrow it from? That typically is, those are the sponsors of those deals.
Okay.
Thank you, Russ.
Thank you, Russ. Any other general questions? So I think all we have to do is just very simply, and I think we don't even approve it, but the pension disbursements and the summary bills was there. Any other comments for the group before we adjourn for the evening? So Jim, our next meeting is the first week of August.
Yeah, August 4th.
Okay, August 4th, and we'll know better as we get close whether we're still Zooming or whether we're back together as a group.
Yeah, I'm hoping things ease up in coming months. So, and I know summertime's always a tough time, so we'll have to reach out. Hopefully, we can retain a quorum.
And thank you all for being accommodative. My wife Mary and I were in Clearwater, Florida last week, so thank you for allowing us to move this meeting up a week. So thank you for that. So if anyone else has anything for the good of the order, does not have anything else, I will make a proposal that we adjourn this meeting. Can I have a second?
Second.
All those in favor?
Aye.